Hello, and welcome to another edition of Market Brief After Hours. It's great to have you with us as we unpack the trading week that was. It's been a fascinating few days on the markets, characterized by a real tug of war between some genuinely positive economic data and a growing sense of unease regarding the tech sector.
It certainly has. If you look at the headlines, you might think the market would be celebrating. We had a softer-than-expected inflation report, which is usually music to investors' ears. But instead of a broad rally, we saw a mixed close on Friday and a second consecutive weekly decline for the S&P 500. It seems that while the macroeconomic picture is clearing up, the micro picture, specifically concerning artificial intelligence and structural disruption, is getting a lot murkier.
That's a really interesting dynamic. Usually, when inflation cools, stocks heat up. But let's look at the scoreboard first. How did the major U.S. indices finish up the week?
It was a very fragmented session. The Dow Jones Industrial Average actually managed to buck the trend slightly. It added roughly 49 points, or 0.10%, to settle at 49,501. That index benefited from a rotation into defensive and value-oriented names, essentially investors looking for safety.
And the broader market?
The S&P 500 was effectively flat. It edged up just 0.05% to close at 6,836. But the important context there is the weekly performance. The S&P notched a weekly decline of 1.4%. It's struggling to build momentum. Then you have the Nasdaq Composite, which really bore the brunt of this sentiment shift. It fell 0.22% on Friday to close at 22,547. That capped off a 2.1% weekly loss. The selling was concentrated in software and fintech, which circles back to those fears about AI disruption we mentioned earlier.
It's fascinating to see the Nasdaq lagging like that. You mentioned the inflation data earlier. Let's dig into that. The numbers looked pretty good on paper, didn't they?
They did. The January CPI, Consumer Price Index, came in cooler than expected. Headline consumer prices rose 2.4% year-on-year, down from 2.7% in December. Core inflation, which strips out volatile food and energy, eased to 2.5%. That is the lowest level since March 2021.
That sounds like exactly what the Federal Reserve wants to see.
Absolutely. It was driven by slower housing cost growth and cheaper petrol. As a result, we saw U.S. Treasury yield slide. The 10-year yield fell more than 5 basis points to 4.05%, and the 2-year dropped to 3.406%. The bond market is pricing in a higher probability of rate cuts later this year. But, and this is the key takeaway, equity investors are so worried about earnings sustainability in the face of AI changes that they largely ignored the good news on rates.
So, good macro news is being overshadowed by sector-specific anxiety. Let's hop across the Atlantic. How did European markets handle this mix of data?
It was a mixed bag in Europe as well, as they were dealing with the same AI-driven sell-off cues from the US, balanced against their own economic data. The FTSE 100 in the UK performed well, rising 0.3% to 10,434, largely because it's heavy on defensive sectors, which are currently in vogue. Germany's DAX also snapped a 3-day losing streak, advancing roughly 0.3% to 24,915. Switzerland's SMI was another bread stock, gaining 0.52% to 13,601.
But not everyone was in the green.
No, France's CAC 40 slipped 0.31% to 8,315, and Italy's FTSE MIB took a significant hit, dropping 1.62% to 45,473. It's worth noting, though, that the macro backdrop in Europe is improving. The Eurozone economy expanded 0.3% in the fourth quarter, beating expectations, and employment has risen for the 19th straight quarter, so the fundamentals there are actually quite resilient.
That's a good sign for the global economy. Before we move on to the currency markets and individual stock movers, let's take a quick break. We'll be right back. Welcome back to Market Brief After Hours. We've covered equities and inflation, but I want to turn our attention to the Forex markets. There's been a lot of technical movement there. Let's start with the euro against the dollar.
The Euro-USD pair has been interesting. It ended the session at 1.1874, just edging 0.03% higher. It's been moving in a very narrow range, essentially pausing for breath after a strong rally. From a technical perspective, the bulls are still in control. The pair is trading well above its key simple moving averages, or SMAs. We have the 50-day SMA at 1.1756, the 100-day at 1.1684,
and the 200-day at 1.1632. Since the price is above all of these and they are aligned positively, the trend remains bullish. The 1.1800 level is acting as strong structural support.
What about the British pound?
The GBP USD is showing a similar constructive setup. It closed at 1.3655, up 0.24%. It actually finished near the top of its daily range, which is a sign of strength. Looking at the averages, it's holding above the 50-day SMA at 1.3508 and the 100-day at 1.3388. Even the 200-day average at 1.3427 is providing support. It looks like consolidation following that sharp rally in late January rather than a reversal. If it can break immediate resistance at 1.3659, the next target is the early February peak near 1.3800.
And finally, for the major pairs, the Australian dollar?
The Aussie dollar pulled back a bit, closing down 0.21% at 0.7047. It tried to push higher but retreated to the lower end of the daily range. However, the broader uptrend is still very much intact. It remains firmly above its 50-day SMA at 0.6788, the 100-day at 0.6659, and the 200-day at 0.6586. As long as it holds above the support level at 0.7043 and the prior swing area near 0.6900, the structure of higher highs and higher lows persists.
It sounds like the dollar weakness trend is pausing, but not reversing. Let's look at commodities. Gold and silver had a strong bounce, didn't they?
They certainly did. Gold settled at $5,029, gaining 2.21%. Strong buying interest emerged from the session lows. Crucially, gold continues to trade well above its long-term averages. The 200-day SMA is way down at $3,855. This confirms the long-term bullish trend is healthy. Silver also rebounded, rising 2.23% to close at $76.90. However, silver is in a slightly trickier spot technically. It's still below its 50-day SMA of $79.08, which acts as immediate resistance. It needs to clear that zone to really get momentum back, but it is holding comfortably above the 200-day average of $50.59.
And we can't talk about alternative assets without mentioning Bitcoin. It seems to be waking up again.
Bitcoin had a significant recovery, ending the session around $68,800. That's a 4% jump from recent lows. It recently tested the $60,000 threshold, which is a massive psychological and technical pivot point. There's a lot of risk management happening around that number. Options data shows a huge concentration of put contracts, betting on a price drop below $60,000. If Bitcoin were to breach that, it could trigger accelerated volatility. But for now, it's finding support from the 200-week moving average, which sits just above $58,000.
That rally in Bitcoin obviously spilled over into the equity market. Let's talk about the market movers. Who were the big winners and losers this week?
The crypto-linked stocks were definitely the standout winners on Friday. Coinbase Global led the gainers in the S&P 500, closing up more than 16%. You also saw Mara Holdings up over 9% and Riot Platforms rising more than 7%. It was a broad wave of buying across that sector.
But it wasn't all good news. We saw some heavy selling in other areas.
Right. DraftKings took a nasty tumble, falling about 13%. They beat their Q4 earnings expectations, but they issued a disappointing revenue forecast for 2026. The market rarely forgives weak guidance. Similarly, Ryan Specialty Holdings and Bio-Rad Laboratories both dropped more than 12% after missing their quarterly consensus estimates.
On the flip side, I saw some massive moves for Rivian and Pointe Homes.
Huge moves. Pointe Homes jumped over 26% following news of its acquisition by Sumitomo Forestry. And Rivian, the EV maker, also surged more than 26%. They beat revenue estimates and, crucially, issued stronger delivery guidance. In an EV market that has been struggling with demand questions, that was exactly what investors wanted to hear. Also, a quick mention for Roku. Shares rallied more than 8% on a strong outlook and better than expected revenue.
So to wrap this up, we have cooling inflation, a resilient but cautious Europe, technical strength in Forex against the dollar, and extreme volatility in single stocks driven by earnings and AI fears. What is the main takeaway for investors heading into next week?
The market is grappling with a complex transition. The inflation fight seems to be winding down with success, as evidenced by that 2.4% CPI print. But the tech disruption narrative is just ramping up. Investors are trying to figure out which companies are safe and which are vulnerable to AI. That's why you see the Dow holding up, safety, while the Nasdaq slips, growth, disruption. The focus next week will likely remain on whether disinflation trends can stabilize sentiment enough to counteract these structural fears.
It's going to be a fascinating few weeks ahead. And thank you for listening. We hope this breakdown helps you navigate the week ahead. If you find this useful, please follow Market Brief After Hours to stay updated. We'll catch you next time.